All right, very good day. My name is Christopher Ng Wai Chung. I'm the Dr. Wealth trainer for the Early Retirement Masterclass. I run a blog known as Tree of Prosperity. I am a financial author, and I'm here to do a Q&A for everybody with our first question. Questions are random, so all right. When you are younger, do you already have a retirement age in mind that you work towards, or do you just go with the flow? Okay. All right. So when I was younger, I wasn't particularly conscientious about my money or my financial management. Right. I have a tendency to just go with the flow, but when I was working as an engineer, I really wanted to become a millionaire. And in those days, the idea of financial independence have not come into prominence yet, right? And so you don't have social media or blogs in those days. Okay, so, all right, we're done with one question. All right. Okay, next question. What triggered you to start investing, and how did you choose to invest back then? Okay, I think it's a series of events that led me to become interested in investing. When I was an undergraduate, I was learning how to date women. So I dated a senior of mine in an informal date. That means we're not serious, but I'm just practicing how to date. And so I went out with her and we had a meal together, and she was explaining to me her thought processes behind looking for someone to settle down with. And one thing I noticed is that throughout the entire conversation, she seemed to be fixated with the idea of dating doctors. So she said that she's a science student and she likes to hang outside the medical faculty. And she would wait for the doctors to come out from the lecture theatre and then she would pounce. But that's not the only incident, right? Another incident, a friend of mine who's a law student, he came to me and he complained to me. He said, Chris, I've got a problem. I said, what's your problem? He said, well, there's a girl stalking me in the lecture theatre and she's sort of following me everywhere, right? And it's led to a lot of thoughts about my position in life as an engineering student. And I came to the conclusion then that I think the main reason is because the earning capacity of these professions are higher than the earning capacity of engineers, right, in those days. And so I came to that conclusion that money is very important, right? And if you want to succeed in the dating world as well, you need to work on your own finances and build yourself up, right, to be someone that's worthy of being in a relationship, okay? And so I think that was one of the formative moments of my life, right, before I became an adult. And of course, that sort of led to my interest in investing. Okay, so it's sort of that's a weird story for you. Okay. All right, third question. Would investors be better off investing in growth stocks rather than stable counters like REITs if the assumption is global economic growth? If the assumption is global economic growth, then the question is, I would say, loaded, right? It's a loaded question. It has global economic growth, therefore growth stocks would normally trump value stocks or REITs. Okay, but I'd like to offer a different kind of explanation on why I actually prefer REITs and value stocks rather than growth stocks. People know that I like to write computer programs and I like to do simulation on time series and stock prices. And here's what I've discovered. If you invest in growth, a lot of these strategies are momentum driven. So generally what goes up would continue to go up into the future. But if you look at REITs and you look at value stocks, a mean reverting strategy it becomes more important. So what goes down have a tendency to retrace and go up, and what goes up have a tendency to come down. So in such a case, if there is global economic growth, then these momentum strategies would become more important when you buy growth stocks. But for me, I sort of believe that I prefer REITs because REITs have a tendency to bounce when they tend to do badly. So when times are doing badly, I could actually go in, do a little bit of bargain hunting and make my money at some time in the future. But if you're like the tech investors of today and you are actually buying a tech stock, if the tech markets were to actually retrace or drop like what's happening right now, there is a lot of fear in the markets because as in the case of 2001 and 2002 when there was a dot-com crash, the crash can last for a very, very long time. Okay, so I hope that sort of answers the question of whether you're better off investing in growth stocks if the assumption is global economic growth. The answer is yes, you'll be better off, but you'll be much better off looking at value stocks if you do not know how the economy would move in the near future. Okay, next. Okay, how would you advise a beginner to begin, right? Give real actionable and impactful advice, not some stock paragraph must add value. Okay, right, for a beginner to actually start investing, there are two prerequisites. Okay, the first prerequisite is you must be able to earn some money by selling your time, right? You need to be gainfully employed and you must be able to earn some money in the first place. Otherwise, how are you able to invest your money later? And of course, that's not enough, right? On top of it, you should be able to save a significant portion of your money so that your portfolio will be of a reasonable size. Now, once you get that out of the picture, right, what you want to do is that you want to look for a strategy that is forgiving, right? When I say that the strategy is forgiving, you want to look for an asset class with a relatively low standard deviation, right? Where there is low market risk. So when you make a mistake and you pick the wrong stock, you wouldn't beat yourself up so badly, right? So I would say that for a beginner, you might want to look at things like the STI, right? Some of the counters in the Singapore STI, very forgiving because it recently came up to be the worst stock market of 2020. So I think that there is still some bargain hunting that can be done within Singapore, right? REITs are powerful because it's forgiving because they pay you twice a year or 4 times a year. So even if you do not pick the correct REIT, somehow if you're collecting rent from someone, you will be rewarded for holding on to your stock portfolio. So I think a beginner should start with these conservative strategies before deciding whether they want to move on to something sexier like growth stocks or technology stocks. There's absolutely nothing wrong with growth stocks or technology stocks, but you also need to go through a period of self-reflection. Understand your own risk appetite before you decide to go into doing something riskier. All right? Okay, let's move on to the next question. All right, I think this is a question about my wealth, right? Do you want to spend it, pass it on, or give it away when you pass away? All right, this is a good question. I have a different approach when it comes to giving my wealth away compared to a lot of people, including a lot of trainers. I think there's this conventional idea when you speak to a lot of people that people do not want their children to have such an easy time. So they want to limit the amount of wealth transfer to them, right? People who believe in these things include people like Bill Gates, right? So for me, I take the opposite view. I believe that money should be given to children at a much earlier rate, earlier than hopefully before I die while I'm still around. So I prefer to make sure that my children have a nice 6-digit portfolio to play with the moment they hit 18 years old. The reason is because the mindset that is required to manage a 6-digit portfolio is very different from the mindset, the same kind of mindset that I had when I was an undergraduate who had to deal with a 3 to 4 figure portfolio. And when you have $100,000 to play with at the age of 18 years old, you have the freedom to do a little bit of diversification, and the dividends that you receive from the portfolio is meaningful enough to be able to sustain a very, very simple kind of lifestyle. And this way, it actually molds your children from my perspective to actually become more responsible about their use of money. All right, and of course, what I propose is very controversial, and it also means that my children will be very lucky when they become 18 years old. But I think some people from the high net worth category are actually in alignment with what I'm trying to do. All right. So for my answer is pass it on, but hopefully pass it on while I'm still alive, so that I could rein them in. If, like, for example, my son ends up being a playboy and he gets a Lamborghini, then he needs to be stopped, right? Then I will just take the money back, right? Okay, next question. Okay, starting capital to take you where you are today, all right. My starting capital was negative $20,000. When I first graduated with an engineering degree, I had to pay back my father what was owed. Fortunately, I owed my father's CPF and not my dad, so I was able to, on the second year where I obtained my company bonus, I returned the money to my father, and then my father cancelled the loan. Okay, a decent starting capital to build a dividend portfolio would be about $10,000. $10,000 would give you a reasonable $500 a year, and you should be able to enjoy the benefits straight away. And one of the things I talk about is you can have both a Netflix and a Disney Plus account at the same time, right? If you are able to put up a $10,000 portfolio of real estate investment trusts as well as Singapore blue chips. So that's a good number to start with. If you do not have that amount of money, do not be discouraged, all right? Work hard in your day job and be able to save a certain amount such that you'll be able to build this portfolio within 6 months to a year. Right. Okay, next question. How would you advise a seasoned investor? All right, one of the things I realize about the retail investment markets is that retail investors basically operate from a notion of narratives, right? They operate by listening to stories. People tell you a wonderful story about Tesla, about Elon Musk. You are charmed by the storyteller. You put your money into Tesla, right? I would suppose that you take a different tack, right? My preferred approach is cut off the stories and look at what the science really tells us, right? One of the things I teach my students to do is that we dive into a market and we want to see what people say is really true. Like, for example, when people say that low price earning stocks have a tendency to outperform, we want to know whether this claim is true, so we test it out in the markets, right? Similarly, do the REITs that pay the highest dividends outperform, right? So as we're able to conduct these scientific experiments, we are able to explain to ourselves that, well, these are the things that we look for when we look at a financial market. And based on this science, we can shortlist about 8 to 10 stocks that are worthy of further examination. So we do not have a notion of stories. We have numbers to guide where we go. And only after we get the 8 to 10 stocks, we look at the stories one by one and we find the best stories that we like. All right. So I think this is something that seasoned investors will need to learn. All right. Instead of jumping to the story straight away, why don't you take a few steps to reduce the number of stocks that you want to look at, so that you have the time to focus on the best stories, all right? Okay, so we're done with the next question, and I think there are 3 more questions to go. What are the key risks of investing in REITs right now? Okay, I think the most important risk of investing in REITs right now is very obvious. It is COVID-19, and if you look at COVID-19, one of the key issues is whether work from home would permanently impact the valuation of office REITs. That is a big question that cannot be answered right now, because we've not come to the stage as to we can assess whether bosses will actually force their employees to go back to the offices once COVID is over. So I think that's one element of risk right now. To actually guide my students on investing in REITs, I take a very unconventional stance. I tell my students to look at the COVID-19 numbers, their infection rates, this thing called the R0. What is the vaccination rate of a geographical region, to decide whether it is time to actually jump into retail or office REITs. And I think the people listening in may want to think in terms of the virus rather than the REIT fundamentals, because the truth is that retail REITs and office REITs are underpriced right now. But the question is, would there be any value to these properties if people simply stop going shopping or going back to the offices right now? And this is the million-dollar question, right? Neither myself nor my students can answer it right now, so we're monitoring the situation very carefully. Okay, I think we've got a second last question here. What do you think of the current market in Singapore? Okay, the current market right now is that our PE ratio ranges from about 18 to 20. Our current market is neither cheap nor expensive, right? When you are in this state where the current market is neither cheap nor expensive, your ability to select stocks is particularly important, because if the markets were to be flat and it were to go nowhere, right, you need to still find ways to actually improve your investment performance. And it is this particular climate where dividends investing is particularly very strong, because if the markets do not go north or south, then everything will be determined by how much rent you collect, how much money that you can squeeze out of a particular business. All right, so this is my view of where the current market is right now, and this is a very good time for defensive yield plays, right, given that interest rates are also fairly low at this time. Okay. Finally, what is your self-realization about money and life? Okay, for me, I think the most important self-realization about money and life is that sometimes money doesn't make you a better or worse person. Money actually amplifies what kind of person you are, right? As I've seen many cases of not just students but friends who take the same journey as me towards financial independence, you realize that the students that really like to eat would then use their dividend payments to get higher quality food, go to better restaurants, right? But you also find students who, like me, are very willing to learn, very interested in reading books, and you will find that we will then use our dividends to, like for me in my case, go back to law school, attend courses, right? And so money doesn't really make you a good or a bad person, but it really does allow you and give you more freedom, right, to actually find out who you are and do more of the things that you like. All right, so I think that's the most important realization about money and life. And we are done with all the questions that's been given to us one day. You want to find out more about what I do? I think the best thing you can do is to sign up for the next early retirement masterclass preview, okay? And there should be a link to the webpage for you to do that. Thank you very much.
Done.